There are two tax codes in the United States. Most people believe that's one for the rich, one for the poor. Reality, it's one for the informed and one for the uninformed. Now, tax preparation is what we do every April 15th, where we tell the IRS our story and we endure the consequence. Tax planning is getting to tell the story by putting our assets, our investments, our decisions in the appropriate boxes along the way before the end of the year. Tax planning is what the Financial Enhancement Group does with each of your CPAs, with each of the families that we deal with prior to the end of the year. Starting October 1st, it's game on. It's all about tax planning, not just tax preparation. If you want to work with certified financial planners, CFA, chartered market technician, enrolled agents, CPAs, if you want us to collaborate with your CPAs, call us now at 800-928-4001 or go to yourlifeafterwork.com. Get your tax planning in alignment with your investment planning. Again, that's 800-928-4001 or yourlifeafterwork.com. Well, good morning and welcome back to your Retirement Playbook. I'm your host, Joe Clark. So happy to have you along. Hey, many of you know, most of you know, that I've been part of the Ed Slott Elite IRA group since its foundation. Hard to imagine that at 16, 17 years old now. I was on the board for 10 years. We meet twice a year for 3 days, so 6 days of my life professionally. We read private letter rulings, go over tax code. That's our focus. I'm there with 400 of my closest friends, including Aaron Rayum, our director of financial planning, but it's CPAs, tax attorneys, and other geeks like myself that understand the importance of tax planning. One of the things that I understand when it comes to tax is that simplifying your life is the best thing that I can possibly do. I don't want to be bothered. You don't want to be bothered, likely, and there's things that we can do to eliminate that bothering. In all of the years I've been in the industry, one of the things that I've heard that bother people the most is having to make quarterly payments, right? So when you become retired, before then, you had a W-2 where your employer withheld money out of your check. Unless you were self-employed, then you've been making quarterly payments all the way along. But your employer withheld money out of your check. They sent it directly to the federal government and usually the state as well. And you didn't have to make any quarterly payments. And then all of a sudden you would get to the end of the year and you would either owe the IRS or they would owe you. Most of the time they would owe you money back, right? So you gave the IRS, congratulations, an interest-free loan. That's a whole nother story. We won't even get into that. When you go to retire and there's no money being withheld from your check, especially going to the state, now all of a sudden you have to make those infamous, tiresome, and many times problematic quarterly payments to the Internal Revenue Service. They're confusing. They're complex. You've got to pay based on when the income was recognized. So if you did a Roth conversion during the middle of the year, your quarterly tax payment for that quarter should go up, or you're going to assess pesky little penalties and interest charges. Maybe you had a sale of a capital gain of a rental property or farm ground or even inside of your portfolio. Many different things can happen. But if you happen to have an IRA, things can get a whole lot simpler. See, there are two tax codes in the United States. You've heard me talk about this for years if you've been listening to the show. It's now 25 years old. Thank you very much. But if you've been listening to the show for a long time, there are two tax codes in the United States. And it's not one for the rich and one for the poor. It's one for the informed and one for the uninformed. And I would even add a third criteria to that. You know, to know and not to do, you might as well have not known, right? Here is an easy way, a simplified way for you in certain circumstances to be able to get around having to make quarterly payments. Now, my friend Ryan McEwen is with the Wealth Enhancement Group in Minnesota. He's also with me on the Ed Slott Group. Good friend of mine. He's a CPA as well as a certified financial planner. And he wrote about this in an article that just came out very, very recently. He calls this the triple threats of tax planning when it comes to quarterly payments. And it's actually when it comes to any taxation. It's the threat number one is tax overpayment. You gave the IRS too much money. And at the end of the year, you either apply it to the next tax pay period or they refund it to you where you get an interest-free repayment of your own money. Secondly is an underpayment. Oops, you should have given them more. I hate paying the IRS interest. I hate penalties even more. And the penalties and calculations can be a challenge. So those are the three: making sure you get the penalties and the calculations right, having an underpayment or having an overpayment are the other two. Let's eliminate the triple threat. Well, how do we do that? Well, the answer is if you have an IRA and you're over 59 and a half, so you've separated from the workforce, you can have money taken out of your IRA without any 10% federal penalty, right? If you're inside of a 401k, you can make distributions the same way. I think it's easier, frankly, to coordinate from our end using an IRA. But it's one of those secrets to understanding the tax code, right? When you make a quarterly payment, when I sit down at my desk and fill out that bloody check every quarter, because I'm not 59 and a half, I have to do it this way. When I fill out that check and I remit it to the IRS or submit it, whichever one you want to talk about, it's painful. I have to deal with the triple threat. Is it enough? Is it too little? You know, am I dealing with the penalties being correct in the amount? But if I were over 59 and a half and separated from the workforce especially, where I had to make quarterly payments, and I worked for a company instead of being self-employed, here's one of the things I can do. I can merely instruct my IRA to make a distribution and have 100% of it remitted to the IRS. So let's say over the course of the year, my CPA said, Joe, you need to make 4 quarterly tax payments of $10,000 a quarter, right? So $40,000 in total. I missed the first one. I missed the second one. I'm on the golf course with my CPA, and he says, Joe, you're going to have to pay penalties, and you're going to have to pay interest because you didn't make the quarterly payments that I told you to make. And I go, not so fast. I'm going to have the full $40,000 taken from my 401k or my IRA and distributed directly to the IRS. The IRS is going to receive it, but strangely enough, under the rules, it's not based on deemed to have received it on one date. It's done pro rata over the course of the year. As a result, all of my money was in on time. There is no penalty. There is no interest. Voila. It was simple. It was easy to do. Right? So let me walk you through the steps again. You've got an IRA. You've got quarterly payments that are due. You merely make a distribution at the end of the year to take care of all of those quarterly payments at one time. If you're at required minimum distribution age, that's a pretty simple decision to do. Your RMD is what goes to the IRS. It may be enough. It may not be enough. Add to it if you need to. Pay them less to satisfy the requirement for what would have been your quarterly payments. Except now you're only having to fool with the IRS one time a year. Secondly, what if you didn't want to take an IRA distribution? Because again, that would be more taxable money. Pretty simple. You've got 60 days to be able to replace that money with money from a taxable account. So you may have a trust account. You may have a joint account. You may have an account in your own name. You just sent the IRS $40,000. You've got 60 days to replace that money out of an IRA, not a 401k. You've got 60 days to replace it in an IRA. Merely take $40,000 out of your trust account or your retail account, put it inside of your IRA account. Voila! There is no taxable stuff. Now remember, you can only do that once every 12 months. That's not calendar year. That's once every 12 months. So pay attention to the clock in terms of when you do that. There are also some Roth conversion strategies we can talk about this. Now, for the self-employed person, this becomes critical. And Ryan gave a great example, so I'm not even going to make up one or come up with one of our own. He had a high-end pet company that sold, the toys and the things like that, pet food, that did really, 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 really well, that had to make quarterly payments of $200,000 a quarter to the IRS. That's a big ticket. So $800,000 going out to the IRS over the course of a year. Think about the triple threat, right? Is it too much? Is it not enough? And what will the penalties and interest be? Well, in this case, a major retailer, a big box store, moved in right next to them. And they were afraid that their sales may go down at the end of the year. And as a result, if they made their quarterly payments on time, they would have avoided the penalty and interest, but they also may have been and threatened by a massive overpayment. If their profitability wasn't there, they've given up cash flow they may need to keep the business going. By using the IRA strategy, essentially, what they were able to do was to give themselves more flexibility in terms of how to structure or how to look at this. So they made no quarterly payments. They got to the end of the year. Voila, sales didn't go down. Profitability actually went up. They went into the IRA and they were able to make a single distribution, able to go in to satisfy the IRS so that it looked like the quarterly payments were made across the board. This is not cheating. This is not, doing anything against the tax code. This is using the system as it is written, ladies and gentlemen. I don't want you to think that we're doing anything at all that is wrong with the tax code. We're merely understanding it. Remember, there's two tax codes, one for the informed, one for the uninformed. Right? This is a process of simplifying your life. It's one of the things we do at the Financial Enhancement Group. So in this case, the company had the profitability of $1 million. They were able to put it back in the IRA. Remember, you've got the 60 days. It wasn't taxable. Everything was good. You don't have to be 59.5 if you think you can replace, by the way, if you're still making a quarterly payment and you're under 59.5, you've made the distribution, if you will. Just pay attention to that with your CPA. Money that is leaving is subject to that penalty, but you have the 60 days to be able to put the money back into the account. So the key with tax planning is to make sure that just because you know doesn't do you any good. You actually have to do. Secondly, it requires a lot of thinking and planning ahead of time. You don't want to get caught into what do I do now? Now, truthfully, we get a lot of questions starting in October. That's when we do our tax package that goes out to all of the families we take care of. Happy to get you one if you would like to. You can merely go to yourlifeafterwork.com or call us at 800-928-4001 and say, hey, I want to be on the tax package distribution list. We will send it out to you. We go through about 10 questions for people every year, from income variability to marital changes, whether that be death, divorce, marriage, children. What's changed inside of your tax scenario and what do you need to really think about it. One of the things we're going to highlight in this next week is what's happened with inflation and taxation and how do those two things go hand in hand. We've got to be thinking about our tax planning before the end of the year. How do we simplify? How do we simplify? How do we simplify? That way you have a better chance of acting. Remember the triple threat. We don't want to overpay the IRS. We don't want to underpay the IRS. We don't want to get caught calculating penalties and interest and making sure that computation is right. Let's remove the headache. Let's simplify this. Go to yourlifeafterwork.com or call 800-928-4001. Go to yourlifeafterwork.com. Let's get started on your next steps meeting.